All right, I'd like to welcome everybody to the July 2026 webinar from Fluent Financial. I'm Mitch Kramer. I'm the founder and CEO of Fluent Financial. Trey will be joining us momentarily. Kind of an interesting last 30 days. I know we talked a little bit last month about the big bubble that was forming in the memory and semiconductor area. And June 22nd has turned out to be the capitulation day. There's been a pretty significant retreat from those areas of the marketplace. So we'll spend some time talking about that. So first thing I want to talk about in the meeting is kind of what the markets have done recently. So if we go back and look over the past year, you're going to see that this top blue line here is emerging markets. And the emerging markets has some Far East Asia, South Korea, Taiwan, and had a lot of memory and semiconductor stuff in it. And this area started to roll over in June. You can see it's really declined pretty precipitously since that time. The small cap area is about 36%. The NASDAQ market is up about 28% over the same time period. Global market's up about 13%. What's been interesting is that the GDP is still holding up. Employment looks good. We're seeing inflation come down. A lot of the inflation numbers had come down with the price of oil and gas. The Iran conflict is starting to reignite. It's probably going to have an impact on inflation going forward. So this next slide is the leading economic indicator index. And we've talked about this for years. And I think what's important, because we've got a lot of questions about this that, Mitch and Trey, you talked about this recession. The recession never happened. What happened? So what's interesting is if you look at this chart, and zero is basically if you're above it, you're growing. If you're below it, you're shrinking. That's the LEI, leading economic index. So we have been below this line really since 22. And this line was moving downward pretty significantly. And for about a 2-year period, that's what this red line indicates. It's a recession signal. What's interesting is this is the first time in about 100 years that this has ever happened where we did not have a recession. Here it was in the COVID recession. This is the Great Recession of 08 and 09. And here's the dot-com recession at the beginning of this new millennium. So many of the people on this call are either retired or going to be retired soon. So when we see this happening, we are not going to be taking a lot of risk in clients' portfolios because it would almost be malpractice if we saw this train wreck coming and we increased risk in the portfolio. So we had more risk off trade. We had a lot more bonds in the portfolio because interest rates did go up significantly, which means bond prices fell. And we see the recovery here almost positive. Now, the last data we have is through the end of May. So the next chart we'll take a look at, and I talked about this in kind of the summary, is the memory and the semis have started to roll over. So these sectors had a phenomenal second quarter up to about June 22nd. And what you'll see is this top line here, it's up 64%, but it's down about 50% from its high point about 120. You look at the semiconductor space, you see in this rollover, this area here with AI semis has decreased very significantly. Then if you look at the equal weight S&P, which is this purple line, the MSCI, the EFA index, which is large cap foreign, is actually down over the same time period. So this area of the market did extremely well in the second quarter, but is coming crashing down, and we've been able to avoid a good part of this. And the kind of continuation of this, you look at what's happened from the windshield perspective in the rearview mirror. So if you look at the S&P 500 software industry, it's basically been flat over this period from the end of February through about June, the end of June. The memory area, that's where all the great growth was up, had done phenomenally well, up 127%. Now, if we go to June 22nd, which represented the capitulation day, what's been very interesting is this segment over about a 3-week period has lost 24%, where the other part of the software area, which we've had money invested in, is actually up 7%. Those of you that who've been in the value and opportunity portfolio, great first 2 months of the year, horrible second quarter. I think July, you're going to be very pleased with what you've seen. Now, we talked a little bit about the emerging markets area in the portfolio. And what I want to show you now is a little more detail. I mentioned that a lot of it's in the South Korea area because there's a lot of chip and memory. Now, we decided to get in a little bit more heavily in emerging markets in December of last year, and it had a very significant rise up. Now, emerging markets, the product that we use is the iShares EEM is the ticker symbol. It has a lot of South Korea in it. We made a decision in mid-June because we saw this starting to roll over that Trey's going to be joining us here. We saw this starting to roll over, so we decided to get out of EEM, lock in those gains, and then switch into the Vanguard equivalent ETF. It's EEM, but doesn't have the memory exposure that EEM did. So we didn't abandon the sector. We did reduce our exposure to it, but we're able to lock in some nice gains. So, Trey, are you with us?
Yes. Yes, I am. Thank you.
All right. I'll talk a little bit about this slide and Trey can add to it. So what are we looking back? We're looking at a pullback in the overall market, or is it a rotation? And we think it's more of a rotation. And Trey, I'll let you talk a little bit about this because you can see the S&P 500 index and then the implied correlation. There's a huge gap here, and there's some significance around that. So I'll let you take over.
Yes. Hello, everyone. If you ever travel to Rockball, don't, because traffic is terrible. But alas, I am here, and what we're looking at, two lines on the chart. The blue one is the S&P 500, and the gray line is the implied correlation. So there's 500 stocks. If everything's moving together, the correlation should be very high. Really, what we're seeing is very low correlation environment. You'll see that there on the chart. And so this is because we've had just this small pocket of, kind of memories and a few semiconductor names that have been moving higher, and the rest of the index really hasn't done much. Some of them just kind of been moving along for the past several months, and some of them have actually been moving lower. And this is generally, not the healthiest thing that we would like to see here. You can see on the chart there that generally low correlation environments led to some sort of pullback. Some were nominal, some were meaningful, and we don't have to have a pullback, I guess is the point we want to communicate, is we don't have to have some sort of risk-off scenario just because correlations are low and there's just that narrow concentration. Sometimes that is the case, but sometimes we get rotation. Where this hot sector kind of cools down and money flows out of it and into other unloved or unattended to parts of the market. We think that that's probably more the baseline. And so actually what that means is as the memory and semiconductor stocks start to kind of abate here, that we'll actually see some good healthy bids in the market in other parts of it. That's where we've been kind of moving to. So we didn't catch that memory bubble, but we know where the puck is going, and that's where we skated to. So we think that that's going to be actually the outcome of this.
And Trey, I think what's interesting, a lot of this uptick has been the investment in AI-related activities. So talk a little bit about what the AI investment looks like compared to companies that are not in the AI space.
Yeah, so this chart here, you're looking at a segment of GDP, and it's the non-residential fixed investment. You're just looking at investment in the country, which is good because it's generally pretty cyclical. It's not so much tied to what the government is doing. And so we kind of split it out here, or this is Deutsche Bank's chart. They're splitting it out between AI-related investment and just non-AI. So think of your organic economy. And so we've kind of had this just bifurcated market, bifurcated economy for the past year or so, where at the consumer end you have high earners doing really well, the bottom 50% not spending. Same with savings, and really that even transcends into the market and the way we're investing in this country at a business level. You'll see the light colored line there, that AI related spending. We're spending almost 4% quarter over quarter into this AI build out. It's very capital intensive, the data centers. And so when we strip that out and kind of desegment it, really the natural economy is not really getting that same type of investment. When you've seen that type of downtick in the kind of the darker blue line, that's generally been a weaker economic environment. But that is where this one is very different, where housing and manufacturing, sure, that's been weak in the rear view, but we've had this amazing offset that a lot of these hyperscalers are spending at this point cumulatively trillions of dollars to build out this AI, and it's helping drive enough activity to keep the economy afloat. So this was a really good look at kind of the two different tales that are going on in the market and how important and big the AI related spending is in this country.
Yeah. So let's talk a little bit about how this relates to earnings in this particular sector.
Yep. So the chart here, you're looking at just earnings per share year over year. You're looking at the NASDAQ 100. That's all the hot tech stocks. S&P 500's in blue there. And then we've got the semis, which has been kind of at the top of the pile there. That's that yellow line. So the earnings year over year have been incredibly strong. I think, a lot of market strategists were looking at somewhere between 15 to 20% maybe through the balance of this year. And the S&P 500 is up over 30% during this time. Semis are up over 150% year over year, far higher than any of the strategists, even at the top end, were thinking. And so that's helped valuations kind of stay in check. Now, we're still really rich. I don't want to make it seem like that, but the earnings have driven a lot of this rally at the indice level because the semis and the memory, these are stocks and earnings that have gone up, threefold over the past 6 months or so. And so that's really what we want to continue to see is a healthy earnings lift that takes some of the risk out of the market. And that's kind of what we're trying to figure out now is is this sustainable? As you can see through the chart, it does kind of move as a sine wave there where, strong earnings growth and momentum generally begets weaker growth and momentum. And so that's kind of what we're asking now is, the past few weeks, we have actually seen a small deceleration, a small hook lower in some of those earnings reports. And so we want to make sure that as we go through this next quarter of earnings reports that's starting now, that we're keeping an eye on this. It's good because, the areas of the market that we're exposed to, at least in the active portfolios, they're not really sensitive to this stuff. So if memory and semi stocks go lower, that's fine. The stocks that we own will continue to do well. But this has been a truly historic year for earnings growth, and we'll keep an eye on it to see if it's sustainable from here.
So and now let's bring it home to how our portfolios have done. It's been a very interesting year, and I told people earlier about how the first 2 months of the year were really good for active. Second quarter was not very good, and July has been fantastic. Our passive models have held up really well.
Yeah, so the chart here on the top portion, you'll see through the benchmarks, it's kind of been an all skate session for the most part. The Dow, the equal weight, all in the same range with kind of where global stocks are, the NASDAQ and the S&P up, kind of low double digits there. The strength has been kind of some of the small cap stocks and in emerging markets. They did a reconstitution in the small cap index. So there were a lot of those kind of memory names that are ancillary, more the photonic stocks that were in there. So that helped lift some of the price performance there. Emerging markets have been very exposed to like South Korea and Taiwan, where Samsung and SK Hynix and a number of other companies are located. So that's been kind of an all skate scenario, pretty good. That's something very different that we've seen in the past few years. It's very welcome, and it's one of the themes that we definitely were pronouncing at the end of last year that we wanted to see this year. So good there. Passive models, kind of on the bottom portion of the chart there, you'll see passive models generally doing pretty well. Even models that are holding 20% bonds are up over 9%, kind of in the same neighborhood as an all stock portfolio. That's pretty rare to see. So happy with that. And, most people's retirement accounts have been able to ride this wave really well. I know Mitch talked about some of that rotation that we did in emerging markets to kind of save from there. Great quarter one for active stocks, bad quarter two for active stocks. You don't catch a memory bubble for 3 months and it impacts your performance. I know Mitch, I think you may have already shown the chart, but most of the market really hasn't done much since this Iranian conflict. It's been this narrow pocket. Good news is quarter three is off to a blistering start. So you'll see that there. While the other passives are kind of catching their breath, ADVP, VNO, VNO's up, over, 5.6% in almost 2 weeks, really since July began, where we just kicked off third quarter here. So this is kind of what we were warning, we were prognosticating from last month. Back half of this year is going to look very different. There's going to be a lot of opportunities, and the darlings that were, catching all the attention in these past 3 months, we're reaching a point where they're at peak earnings momentum. Supply is coming online. Investors are overexposed to that. So those are going to go away. So we need to be focused on what comes next. That's where we've been spending the past several weeks and months getting our portfolios tailored to. And so as memory and semis have, kind of gone away and they're in their deep drawdowns, our portfolios are catching fire really quick. So thank you to all the investors in those portfolios for your patience. Kudos to you. You are making out like a bandit here, and this is really welcome news. And it's not just a theme that's going to last for a few weeks or a few months. The back half of this year is going to look very different, very healthy in terms of breadth of performance. So the run that VNO and all these others for the past few weeks have gone on is going to continue, not albeit at the same pace. But this is a good theme that we've been able to layer into that's going to benefit us for several quarters to come. So we're really happy about that.
Yeah, great job, Trey. Next thing I'd like to talk about is indexing versus active stock selection. This particular chart, we've shared this before in the past. You're looking at a regression analysis, and it basically compares the price earnings ratio, which is on the x-axis, and the subsequent returns on the S&P 500 index. That's on the y-axis. The chart on the left is for 1 year. The chart on the right is 5 years. So what happens is, as you have a longer sampling period, a lot of the data points represented by these gray diamonds will start to congregate around the regression line. So this red diamond basically says this is the most likely outcome for 1 year. A return would be on the S&P 500 would be probably about 8 or 9%. Drops down about 6 or 7 here on a 5-year return. Now, what this means is if the index is not going to be doing as well, what will do better? And that's where active management comes in. That's kind of like the VNO ADVP that Trey was talking about on the prior slide. So this happens from time to time. The PE ratio is somewhat elevated at 20.4. It has been higher earlier, but it has come down a little bit by the end of June. So that's what we see on the price earnings ratio and potential equity returns. Now I want to spend a little bit of time talking about inflation. This chart here is a little bit different. This is JP Morgan's. We normally have the Bloomberg one. Bloomberg likes a black background. JP Morgan likes white. They have a little bit more data here. And you can see the peak of inflation occurred during June of 2022 in the prior administration. Energy was pretty expensive back then. And if we look at this trend, it was trending downward all the way to about February this year. Then the Iranian conflict started and energy prices started to spike up, boosting inflation up to about 4.2%. There was a report that came out recently. We're down around 3.5 now, which is greater than expected in terms of a decline. With the Iran conflict starting back up, it probably will go up from that, but it's too early to tell. But I think some points in this, if you look at the navy blue bars, this is shelter. This is going to be housing costs for either renting or housing prices. We've seen a pretty nice steady decline here. Auto insurance is basically topped out. We're paying a lot for auto insurance. The tariff goods cost has been really negligible in the overall inflation picture. It's basically been energy. So if the energy comes down, that will help. Now, the big part of this is what is Kevin Walsh with the Fed going to do about interest rates, because he wants to be much more hawkish than Jerome Powell, his predecessor, in dealing with inflation. So we'll talk about that here in a second. To continue on the oil theme, let's talk about oil prices, what they've been over the past 5 years and where they may be going. This chart on the left basically shows the price of retail gas prices per gallon. Obviously, in 2022 was a rough year, especially for gas prices, got to about $5 a gallon. This year, you can see the rise up again because of the Iran conflict and the price declining now. It's going up a little bit. I paid 15 cents more a gallon last night than I did earlier. You can see the oil prices or the gas prices for prior years here. This other chart here in the upper right just shows the net imports of petroleum and related products into this country. Well, we've actually been negative for a while, and this basically means we're exporting oil and gas and refined products to our trading partners, which is a good sign, helps us with our deficit. Also means we're not financially dependent upon the Middle East as we were back in the 70s. And that's probably one of the reasons why this Iran conflict's going on, because we don't need their oil and gas. This last chart basically just shows consumers' expenditures on energy. Majority of the people, if not everybody on this call, is in the top 20% of income, pre-tax income. So it's a very small part of your budget. So if gas goes from $3 a gallon to say $4 a gallon, if you say you put in 20 gallons, it costs you $20 more. It's not moving the needle. People that are in the bottom 20 or 40%, that's a much bigger impact on their budget and also gathers a lot of news headlines. But when you look at the overall picture, it's not that significant. Now, we are talking about inflation. What is the Fed going to do? And what we're looking at here is the expectation of what the Fed will do when they meet again. So this month, they're going to keep rates in this 3.5 to 3.75% range. September, this number was going to be raised in this area here, 3.75 to 4.0. That's been moved back 1 month to October. But what it shows is it's no longer 50%, it's less than that. You only see one rate hike on here. Last month, we were going to have two. A lot of this is probably attributed to the lower inflation prints that we've gotten over the past week. Now, if we expand this out and look at a longer period of time and look at what the Fed's estimates are, the market expectations, and you've got this data going back 30 plus years, but on the Fed funds rate, what we have is the market expectations are probably a little bit of a rate increase and then a decrease. And then the Federal Open Market Committee, or the Fed, the blue diamonds, kind of the same parallel line, a little bit less, but the long run projection rate for the Fed funds is about 3.1. That's actually a pretty good rate, because that means the bonds are available to add to portfolios. It can provide diversification and income. The big challenge for a lot of people on this call that retired maybe in the teens or the aughts, this is where the Fed funds rate was 0 to 0.25%. The bond market was effectively closed. So how do you create a retirement paycheck when you can't really use bonds? And that's where we developed a lot of our covered call strategies, because that basically replaced bonds because the bond market wasn't effective. And those of you that were around in 22, you were able to see the impact when interest rates go up, bond prices fall. So it was a very tough year for both equities and bonds in 22. So if we shift gears to the components of GDP growth, are we going to have a recession or not? We don't see a recession on the horizon. The GDP growth for the first quarter of this year was 2.1%. What's interesting is business fixed investment had a big increase here. This is the gray area here. And this is probably a lot of the manufacturing, a lot of the data centers, the build out. The other part that was pretty positive was the government expenditure. And that's basically making up for the government being shut down for a good part of the fourth quarter. But still, 2.1% is fairly healthy. So if we look more to the individual consumer, how are we doing? Our balance sheet as consumers in this country, we're about 204 trillion. We have liabilities about 21.6 trillion. 2/3 of that's mortgage, and the others are auto loans, revolving, and student loans. The debt service ratio, why it has been increasing here on this chart, is still relatively low compared to historic measures. That's healthy. Flows into early delinquencies. This is a chart we follow, and everything looks pretty good overall. One thing that's interesting is the student loan delinquency has come down pretty significantly. I know the government had a new program that went into effect at the beginning of July, where there's two different kinds of programs people can use to pay back their student loans. And I guess people are going to sign up for one or both of those. The only thing that's a little disturbing is the mortgage defaults is starting to increase a little bit here, but auto loans and credit cards seem to be in pretty good shape. If we take a really big picture at what we would call the heat map of our overall economy, what we see happening is a pretty solid economy overall for the whole world. Green is good, red is bad. So you have the Great Recession here, you have the COVID recession here. And if we look at more currently on the right-hand side of this chart, global is okay. Manufacturing has really picked up, and that's very good. Services is still over 50, so it's a lighter green or darker yellow. Emerging markets, which has had a very good rate of return, is way up at 53.6. The US at 52.2. Japan's kicked up. Europe is struggling a little bit, and that's a little bit disconcerting. China is doing well. India is doing well. Brazil's basically flat. Again, what we're looking at here is a pretty solid overall worldwide economy, but we don't see any signs of a recession. So a lot of people say, well, Mitch, should we increase risk in the portfolio? I've got some cash. Should we put it in the market? Is now a good time? So if we look at this chart here, so investing at all-time highs. And when you look at this, people are concerned, well, if I invest money at Mount Everest, am I going to inherit Death Valley? And if you look at a short period of time, like 3 months, yeah, your returns will be less. But if you look at a longer period of time, even if you invest at a new high, your returns will be better over a long period of time. So really 1 year, 2 years, 3 years or longer, you're better off to go ahead and invest now, even though the stock market may be at all-time highs. So I'm going to turn this back over to Trey, and he's going to talk a little bit about our stock of the month performance review and one of the stocks we're looking at for this month.
Right. So looking at a few charts here, are a few stocks that we've featured over the past few months, and we are looking kind of at the feature price, which would include kind of when did we talk about them, what price did you guys see in the webinar here, and then kind of a gain at peak, loss at low. So that's just kind of saying, hey, what are the high-low ranges from when the feature came about? And you can see that most of them have been modest double-digit gain at peaks there. Very low loss at lows figures there. So, Adobe was the last one we featured last month. That's, kind of a 3%, drawdown and then a 19% return from there. And so most of them have been, pretty strong, 3 to 1 to, 4 to 1 kind of risk reward ratios there across them. Good solid blue chip companies. A lot of them you can put in the grandkids' retirement accounts. That's what we're trying to feature here. This is not a stock subscription service where we're just throwing out all the high flyers. These are good, safe, stable companies that we've done the due diligence on that should be around for a very long time and should produce some good long-term returns. This month is another software company called ServiceNow, and we're featuring it this month due to its high, strong growth rates, both at the revenue and earnings level, great, strong free cash flow generator, good recurring revenue and retention models. They do a lot of business to business enterprise IT management solutions. There's a lot of uncertainty around what disruption effect AI will have on software as an industry. We've had about 12 to 18 months to kind of sample and get a lay of the land there and see what impact it will have. For some companies, the impact has been material, and there will definitely be winners and losers. But for companies like Adobe and ServiceNow, these are companies that have stood the test of time. They have strong business moats, and right now we can take advantage of some of the fear that's out there from a low multiple perspective and buy these high compound growers. So ServiceNow is this month's pick. Another good scoop up here and kind of some of this. You put them in the grandkids' accounts, let them return or let them compound for 5-10 years. Be fearful when others are greedy when others are fearful. Right now, the recommendation is a buy on this. It does come with some risks there, so a little bit higher beta. The volatility will be a little higher. Just be aware. But when you can find high margin businesses that are temporarily unloved because people are scared, that's always a layup. So this month is ServiceNow.
Yeah, thank you, Trey, for that. As we kind of wrap up our webinar, I wanted to kind of show you about the bond market and fixed income and some changes we've made to one of our portfolios here at Fluent Financial. What you're looking at here is showing basically the bond yields in the bond market, and depending on when you bought bonds, how well did you do? Now, the higher the inflation, the higher the yield on the bond, the lower the price. The bond prices and interest rates move in opposite direction. So in the 1980s, we had very high record inflation represented by these blue dots. So if you bought a bond here, at this period, you would have got a starting yield of about 14%, and your subsequent annualized 5-year return was about the same. Now, as interest rates came down, bond prices went up. So if you look at the teens and 2010s, here we are here, you're looking at a 3% yield and a subsequent 5-year annualized returns about the same. We get into the 2020s, you're basically looking at losses in bonds and no return at all. So what we did in this environment was to say, let's expand our covered call programs. We introduced stock income at the end of 2019. Well, it did a good job of producing income because the bond market was effectively closed, but it didn't have good market upside participation. So we made a decision in June to shut that program down and move everything into our ADV portfolio, which does the same thing, but instead of writing options on individual stocks, we write them on indexes, the five large indexes. So we were able to write options with a lot more liquidity, but the big benefit is you're getting a rate of return in addition to cash flow. So for people who are needing cash flow, instead of having all that money come from stock income with nominal upside participation in the markets, let's take some of the cash flow and then offset that by selling some of the gains off. And these are all net of fees, 1, 3, 5, and 10-year returns. It gives people the opportunity to still have their good retirement, but instead of being able to write options on a few handful of stocks, we have thousands of stocks built into the various indexes like the S&P 500, the NASDAQ, the small cap, emerging markets, and large cap foreign. And we changed the allocation based on the valuation of those indexes. And we're in these portfolios weekly, doing call options. We have VIX call options to help mitigate risk. Sometimes we'll throw in a bond ETF if we see the opportunity to take advantage of that. So we're going to shut down stock income, which we've done. People that were in it have been moved to ADV. So we're going to open this up for questions. I'll stop the recording now. And